In the decade between 1997 and 2007, residential property prices in Ireland increased by over 300%, almost 4 times the historic norm. This led to what many have dubbed as the world's largest property bubble. And to understand how it happened, we need to go back to the 1980s. For much of the 1980s, Ireland was marked by recession, falling living standards, unemployment, and emigration. Despite high taxes, the country's public debt was exploding, reaching 130% of gross national product by 1987. In a bid to escape economic stagnation, policymakers devised agreements to reform wages, taxation, public finances, among many other aspects of the Irish economy. From 1988, Ireland started to experience a sustained export-led economic expansion. Foreign multinational companies started to take an interest in the country as the number of foreign firms grew from 670 in 1987 to 1,050 by 1996, an increase of 57% in just 10 years. This early progress would lay the foundations for Ireland's Celtic Tiger economy, which would emerge in the mid-1990s. Between 1995 and 2000, real gross domestic product growth in Ireland reached double digits. Unemployment fell from 16% to 4%, allowing the country to reach full employment for the first time in modern history. The economy was booming. However, with full employment came a labour shortage and a reduction in wage competitiveness. By the year 2000, non-agricultural wages had increased by 8% in a single year. It was clear that if Ireland was to maintain the high levels of economic growth seen during the 1990s, there would need to be high net inward migration in order to quell labour shortages, and that's exactly what happened. Between 1997 and 2007, Ireland's population would grow by 12.76%. Net inward migration became especially prevalent after 2004, when 10 new countries from Eastern Europe joined the European Union, and the Irish government chose to operate an open labour market policy to resolve labour shortages. However, many of these migrants would take up positions in the sector which, after 2000, would represent Ireland's main source of growth: construction. Pre-EU enlargement, the share of migrant workers as a percentage of the total construction workforce in Ireland was around 6%. However, by the peak of the construction boom in 2007, this had increased to 17%. So the problem of labour shortages and wage competitiveness in many industries would continue to persist. But from an economic growth perspective, this would be largely covered by the boom in construction. The initial investment in the Irish property sector was rooted in strong supply and demand fundamentals. The country had a rising population with low unemployment and strong income growth, factors which would contribute to the need, willingness, and ability to purchase a home. The total number of dwellings had gradually increased from 1.2 million homes in 1991 to 1.4 million homes in 2000, and real house prices had increased by an average of 14% per year between 1995 and 2000. In other words, Ireland's property market was already experiencing an expansion in the 90s. But this expansion was kicked into overdrive with Ireland's entry into the Economic and Monetary Union in 1999. This was the initial trigger behind the surge in house prices in Ireland, both before and after entry to the EMU occurred. The EMU had two major implications for Ireland's property boom. Firstly, with the EMU came a single independent monetary policy for the euro area that was run by the European Central Bank. The ECB, with the intention of stimulating German and French economies, set euro area interest rates low. However, unlike Germany and France, Ireland was already experiencing high economic growth and inflation. The combination of high inflation and low nominal interest rates resulted in Ireland having very low and oftentimes negative real interest rates during this period. Low real interest rates support higher valuations for riskier assets, including property, as investors who are starved for yield pile into these assets in search of investment returns. Secondly, Ireland's adoption of the euro resulted in the elimination of foreign exchange risk, which allowed Irish banks to borrow money at much lower rates in the wholesale financial markets in order to fund their lending activities. This enabled Irish banks to move away from the traditional banking model, which relied on customer deposits, to this new age banking model, which relied to a significant degree on international markets for funding. At the time, globally, there was an abundance of cheap credit in the wholesale markets. By availing of it, Irish banks were able to pass on lower interest rates to their customers, boosting both credit affordability and availability. The availability of credit to purchase and develop property in Ireland and indeed abroad hit a new level in the 2000s. 2000s. As a result of Bank of Scotland's entry into the Irish mortgage market in 1999, a price war ensued. Each of the 6 domestic Irish banks were competing aggressively both with one another and with foreign banks for lending business in both the residential and commercial property sectors. In a bid to claim market share, banks introduced risky loan products to try to get as many people borrowing as possible. Interest-only mortgages, tracker mortgages, 40-year mortgages, mortgages worth many multiples of your salary, mortgages with loan-to-value ratios equaling or even exceeding 100%, and equity release products which allowed homeowners to extract value from their properties without having to sell. It was easier than ever before to get a loan from the bank for purchasing property, and there was a huge appetite for borrowing among the general public. You see, in the aftermath of the dot-com bubble in the stock market, property investment became the next hot ticket item. It was seen as an opportunity to not only own your own property, which was a life milestone for many, but also as an opportunity to make a boatload of cash at the same time. As a result, housing demand exploded, and loan approvals rose from 4.4 billion euro in 1997 to over 31.4 billion euro in 2006. By 2007, Ireland's personal sector credit to GDP ratio was 95%, the highest in the euro area and well above the EU average of 50%. Although total housing completions increased by over 430,000 units between 2001 and 2007, with 93,000 units completed in 2006 alone, it wasn't sufficient to keep house prices stable. As a result, rampant property speculation and house price appreciation took hold. According to the Department of the Environment, Heritage and Local Government, the average price of a house in Ireland in 1997 was €102,491. This reached €350,242 by the first quarter in 2007. Apartment prices grew in a similar manner, increasing by over 246% in the same period. Properties were also being purchased as buy and hold investments. According to the 06 census, some 15% of the total housing stock, equal to over 250,000 properties, stood vacant, which reflected the speculative nature of the property market. In fact, vacant properties increased by 86% between 2002 and 2006. In addition to prospective homeowners, property developers also had easy access to credit from the banks, just on a much larger scale. Those who had close relationships with senior bank executives were able to secure multi-million, if not billion euro credit lines from the banks in order to fund their construction projects. Creditworthiness was an afterthought for the banks. All that mattered was increasing the size of the loan book. As a result, both the residential and commercial property markets in Ireland were sent into a credit-fueled frenzy. However, it wasn't just the banks that were inciting the Irish property bubble. The fiscal policies that were implemented by the Irish government, which at the time comprised Fianna Fáil and the Progressive Democrats, played a key role in fueling property prices. Policies introduced by the government sought to achieve 3 goals: stimulate economic growth, encourage borrowing and lending, and secure votes. Notable policies which encouraged property market investment included the reduction in capital gains tax from 40% to 20% in 1998, mortgage interest relief for owner-occupiers, income tax reliefs for property construction and letting, and reductions in stamp duty. There were huge incentives to not only purchase and construct property, but to do so with borrowed money. These policies contributed greatly to the rapid rise in property prices during the early 2000s. The government became a huge beneficiary of the property boom, and Irish public finances became heavily reliant on the sector for both employment and tax revenues. In 2007, 13% of the total workforce was employed in the construction sector. As for tax revenues, 30% of Ireland's total tax take in 2006 was composed of corporation tax, stamp duty, and capital gains tax, all of which are cyclically sensitive taxes. Of this 30%, approximately half was attributable to both stamp duty and capital gains tax, two taxes which thrive from property transactions. For nearly 20 years, tax receipts from these sources steadily increased, and in response, the Irish government cut income taxes and increased government expenditure, a populist strategy designed to secure votes. Everybody was profiting off of the property sector: the government, the banks, mortgage brokers, real estate agents, auctioneers, developers, home buyers, investors, speculators, and news outlets. It was in the best interests of Fianna Fáil, the Progressive Democrats, and Irish public finances to keep the property bubble going, and that's what they did, even in the face of alarm bells. In 2006, the IMF noted that growth in Ireland had become increasingly unbalanced since 2002, 2002. With a heavy reliance on building investment, sharp increases in house prices, and rapid credit growth, especially to property-related sectors. In 2007, Morgan Kelly, an economics professor from UCD, claimed that real house prices in Ireland could be expected to fall by 50%. As early as 2003, Pam Woodall from The Economist noted that house price inflation in Ireland was unsustainable and that the market was overvalued. But despite these warning signals and more, the government continued to stimulate the property sector with pro-cyclical policies. In the government's eyes, property could do no wrong, and anyone who said otherwise was largely ignored. In fact, in 2007, during a speech to the Irish Congress of Trade Unions, in reference to commentators who questioned Ireland's economy, then Taoiseach Bertie Ahern stated that, quote, "Sitting on the sidelines cribbing and moaning is a lost opportunity. I don't know how people who engage in that don't commit, because frankly, the only thing that motivates me is being able to actively change something." Bertie could have changed something, his policies, but he, like many others, were blinded by herd behaviour and groupthink. Whether he liked it or not, those who were sitting on the sidelines were in fact correct. The fundamentals supporting Irish property valuations were very weak. Between 1980 and 1997, the rent-to-price ratio for private property in Ireland was in the region of 9%. However, as rent prices failed to keep up with house prices during the boom, by 2007, this yield had worsened to around 3%. The same story was true in the commercial property sector, where in 2006, rents had risen by 5.7% as compared to the rate of price growth, which stood at 23.1%. In other words, the economics of the rent versus buy decision was heavily tipped in favour of renting, a telltale sign of a property bubble. Housing affordability, as measured by the house price to income ratio, significantly worsened between the late 1990s and the peak of the property bubble in 2007. Put simply, Irish incomes did not support Irish house prices. They were unaffordable by all measurable standards. The banks had simply created a perception of affordability by granting riskier and riskier loans, and the government, through its policies, had supported that behaviour. That is how the Irish property bubble came to be. And in 2007, signs of weakness in residential property prices would start to show, with the same fate awaiting commercial property prices just 1 year later. The party was over.